Welcome to this explainer. If you're studying accounting or auditing, it's super easy to get caught up in just memorizing the rulebook. But let's be real, knowing the rules is only half the battle. Today, we're taking those abstract governance and ethical theories and, well, turning them into a literal toolkit for your future audits. We're going to see exactly how frameworks like the King V principles govern actual human behavior in high-stakes environments. Our goal? To understand the why and the how step by step, so you can confidently apply these to real-world business scenarios.
So here is our roadmap for today. First, we'll tackle the production cost dilemma. Then, evaluating rules and outcomes, followed by character, community, and Ubuntu. After that, we'll hit King V ethical leadership, King V governing operations, and finally, compliance and true accountability. Section 1, the production cost dilemma. To really make these concepts stick, we're going to anchor everything in a real-world scenario involving a fictional manufacturing company facing a pretty massive crisis on the factory floor. Okay, let's dive into our first major concept, agency theory. Simply put, this explains the inherent friction between the principals, meaning the owners or shareholders, and the agents, who are the managers running the daily operations. This theory is absolutely foundational in auditing because this separation creates what we call information asymmetry. Think about it. The managers know exactly what's happening on the floor, but the owners, not so much. They're completely reliant on the production manager's reporting, and that creates a massive, massive risk for manipulation. Let's see how agency theory plays out in our specific case study. Our agent, the production manager, is secretly over-allocating manufacturing overheads. Why? To hide his production inefficiencies. And honestly, to make matters worse, just to cut disposal costs and artificially boost short-term profits, they are illegally dumping toxic chemical waste into a local river. All the while, the shareholders are completely blind to this reality. Let's break down exactly how this fraud works on the accounting side. Step 1, the company sets a perfectly normal budget for standard costs. Step 2, the manager takes that approved budget during the actual allocation phase. But then, step 3, the manager deliberately inflates the numbers on the overhead allocation sheets right before processing the journal entries. This magically inflates the inventory value on the balance sheet, totally deceiving the shareholders. Section 2, evaluating rules and outcomes. Now, as auditors, how do we systematically evaluate what this manager is doing? We need strong frameworks. So, let's explore our first set of ethical theories. Answer Immanuel Kant and Kantianism, which is also known as deontology. This is a strict, rule-based ethical theory that focuses purely on the action itself, completely ignoring the consequences. At the heart of this is the categorical imperative. This dictates that we must treat individuals, and by extension society and our environment, as ends in themselves, never, ever just as a mere means to an end. By maximizing his short-term bonuses and destroying the local environment, our production manager is literally using the community and the planet as a stepping stone for financial gain. Under Kantianism, that is fundamentally unethical. So, how do we actually test this? We use the principles of universalizability and reversibility. Just ask yourself, would this manager be happy living in a world where absolutely everyone lies about their financial data and pollutes their own drinking water? Obviously not. So the action totally fails the test of the categorical imperative. Now, contrast that with utilitarianism, which is a form of consequentialism. Instead of judging the strict rules of the action like Kant does, utilitarianism flips the script and calculates the net outcomes. It strives for the greatest happiness for the greatest number of people. It's basically a giant cost-benefit analysis across all stakeholders. Let's apply utilitarianism to our manager. What are the net consequences here? Well, the manager might get a nice short-term bonus, so a tiny bit of happiness for exactly one person. But look at the flip side. Long-term value destruction for shareholders when the fraud eventually blows up, severe environmental harm to the local community, and a huge loss of customer goodwill due to faulty pricing. Under utilitarianism, when you weigh it all out, this action is a catastrophic failure. Section 3. Character, community, and Ubuntu. Let's move beyond rigid rules and mathematical calculations. Let's look at the actual character of the people running the organization. And this brings us to virtue ethics, a brilliant concept coined by Aristotle. It emphasizes the moral character of the individual. So rather than asking, what's the rule, or what's the net outcome, virtue ethics asks, what kind of professional do I want to be? It's all about cultivating an internal disposition toward integrity, finding that perfect middle ground between excess and efficiency. For an auditor, it means practicing honest behavior so consistently that it literally becomes second nature, ultimately aiming for eudaimonia, or a life well lived. And, this concept of character extends to the corporation itself through social relativism and legitimacy theory. Basically, a company doesn't operate in a vacuum. It has a social contract. To maintain its legitimacy and justify its continued existence, it has to harmonize with society's values. Pumping toxic waste into a river shatters that social contract, totally destroying the company's legitimacy in the eyes of the public. It's incredibly powerful to view this dilemma through the lens of African ethics and Ubuntu collectivism. In sharp contrast to Western individualism, African ethics prioritizes the welfare of humanity and community well-being. Ubuntu emphasizes deep interdependence, the core philosophy of I am because we are. So, how does this guide governance? A company applying Ubuntu puts community well-being above individual executive bonuses. Poisoning a local river for a quick profit is a direct violation of Ubuntu, because it severs the life-giving interdependence between the corporation and the very community that sustains it. Section 4, King v. Ethical Leadership. Now that we've properly diagnosed the ethical breaches, let's explore the practical cure. How does the governing body use the King v code to actually solve these issues? King v operates as a really logical flow, starting right at the top. Principle 1 states the governing body must lead ethically and effectively. Principle 2 demands they actively govern the ethics of the organization to enable a strong ethical culture. And Principle 3 ensures the organization's core strategy creates sustainable value across economic, social, and environmental contexts. So let's put this into practice. By actively applying Principles 1 through 3, the board sets a tone of absolute integrity. They foster a culture where a production manager wouldn't even dream of manipulating overheads. Furthermore, under Principle 3, the board ensures the strategy integrates environmental goals. They explicitly forbid cutting corners and guarantee the planet is never treated as just a means to an end. Section 5, King v. Governing Operations. Let's get highly practical here, because good intentions just aren't enough. We have to apply King v directly to the audit risks on our factory floor. What's really fascinating here is how high-level governance dictates specific operational controls to fix that agency theory information asymmetry we talked about earlier. If the risk is over-allocated overheads, the control is a strict independent review by the financial manager. If the risk is inaccurate inventory, we mandate monthly standard versus actual cost reconciliations. And for undisclosed dumping, we require fully transparent reporting to external stakeholders. This brings us right to King v. Principle 7. Principle 7 requires the board to delegate authority to competent management, but, and this is a big but, with strict oversight and segregation of duties. In practice, the person drafting the production schedule cannot be the same person approving the final journal entries. This segregation is literally the physical manifestation of ethical oversight. Let's quickly round out the rest of those core operational principles. Principle 4 ensures external reports reflect true value creation, so absolutely no hidden toxic liabilities. Principle 5 requires objective evaluation of the board itself. Principle 6 guarantees access to independent governance advice. And as we just saw, Principle 7 ensures competent delegation. Together, these guarantee that oversight isn't just a rubber stamp. It's an active shield that catches manipulated data long before it reaches the financial statements. Section 6. Compliance and true accountability. Finally, we must look at how an organization remains accountable not just to its shareholders, but to the law and the public at large. This is governed by King v. Principle 9, Compliance. This mandate demands that legal compliance is embedded deep into the ethical culture. It's way more than just ticking legal boxes. In practice, this means when environmental laws regarding chemical dumping evolve, Principle 9 ensures the company's internal controls instantly adapt to stay compliant. The board also requires periodic, independent assurance that these controls are actually working to protect the firm. So, we've broken down agency theory, tested actions against Kant and utilitarianism, explored the rich community roots of Ubuntu, and mapped out how King v operationalizes all of this. As you step out into professional practice, I want to leave you with one final question. Will your future audit procedures just be a simple checklist, or will they be an active shield protecting your community and your stakeholders? Understanding these frameworks is exactly what transforms you from a mere number cruncher into a true guardian of public trust. Thanks for joining me on this explainer, and I'll see you next time.